Today I will be discussing the revenue recognition principle. Firstly, what is revenue? Revenue is an increase in resources resulting from the sale of goods or the provision of services. The revenue recognition principle is that revenue is recorded when earned, not just when cash is received. For example, this is Mr. Krabs. He owns the restaurant The Krusty Krab, and his best customer is Patrick. It is Patrick's birthday in February, and he wants 100 Krabby Patties at his party. On the 1st of January, Patrick goes to the Krusty Krab and pays Mr. Krab $1,000 for the Krabby Patties that he will receive next month. 1 month later, on the 1st of February, Mr. Krab provides the good, the Krabby Patties, to Patrick. So when does Mr. Krabs record the revenue? January, when Mr. Krabs received the cash, or February, when Mr. Krabs provided the good? The revenue should be recorded in February, not January, as the revenue was earned in February. This is called deferred revenue because the cash was received before the revenue was earned. So, Mr. Krabs' journal entry for January should look like this. Cash should be debited to increase cash, and unearned revenue should be credited to increase unearned revenue. His journal entry for February should look like this. Unearned revenue should be debited to decrease unearned revenue, and sales revenue should be credited to increase sales revenue and show that revenue was earned. Now for another example. This is Bob. He's a builder. In January, Bob built a house and invoiced the customer $100,000. In February, Bob received the $100,000 cash for the job completed in January, the month before. So when does Bob record the revenue? In January, when he provided the service, or in February, when he received the cash payment? Bob should record the revenue in January, not February, because he provided the service in January. This is called accrued revenue because the cash was received after the revenue was earned. Bob's journal entry in January should look like this. Accounts receivable should be debited to increase the amount owed to Bob, and service revenue should be credited to show the revenue earned. His journal entry for February should look like this. Cash should be debited to show the receipt of cash, and accounts receivable should be credited to decrease the amount owed to Bob. In conclusion, revenue should be recorded when earned, not just when cash is received. So, receiving cash before providing the good or service is called deferred revenue, and providing the good or service before receiving the cash is called accrued revenue. Thank you for listening.